That was fun. Hello, welcome to Canadian Money Talk. My first YouTube stream or live stream. If you have any questions, let me know. Personal finance, stocks, mostly Canadian stuff, but I'll look at American stuff too. I hope I get text at the bottom. Ranj, hello. I've been doing lives on TikTok for ages, and this is my first one on YouTube. I thought I would give it a try here as well. Are you in Canada? And yeah, what can I help with? I'm in Edmonton, Alberta, by the way. I can look at a stock for you if you don't know how to start investing. We can go through that. Oh, Toronto, cool. All right, you're a couple hours ahead of me. Yeah, if you're an investor wanting to save for retirement or personal just financial independence, investing is a good way to go. If you do it through work or something, then they've probably set it up for you, or if you got your own brokerage account, then I assume you know a little bit about it. Um, I've been financially independent, meaning not working since early 2020. Burnaby guy. Hey, good question. Should we get defensive on Canadian stocks? Trump will tariff Canada. Not so much. Like, who knows what the guy will do, frankly. But it's actually the American companies and ultimately American consumers that end up paying the tariffs. Like, the man doesn't understand how those things work. Um, so no, I like today, I guess with the announcement, kind of a knee-jerk reaction, all the American stuff went up, especially American banks, because he's going to take off the regulations. Um, Canada took a bit of a hit, at least in my stuff, but no, nothing terrifying. Like based on things like that, and especially guessing at what somebody's gonna do to kind of rework your whole portfolio, that's not my thing. I've got like 60 different stocks, and um, it's just not, I don't want to disrupt my whole portfolio on a hunch. So short answer is no, right? We're sort of guessing at everything. Rand says, what are your thoughts on VOO and QQQ? Everyone else on TikTok recommends it. Yeah, it's fair enough. I own a different version of an ETF. I think it's an iShares one that follows the S&P 500. I don't have anything that follows NASDAQ 100, which is the triple Q. I don't know. I think I'm okay with the S&P 500. I'm personally more of a emerging markets believer because I think that's where the growth is going to be. The US has outperformed for a long time, and I don't know. I don't know how long it's going to keep going. So yeah, but both of those are fine. They're both obviously American, even though they're multinational companies for the most part. So you could argue they cover the rest of the world. Um, VOO and QQQ, you need to supply US dollars though. So if your brokerage has a um, fee for a conversion, it's usually 1.5, 2%, then each time there's a transaction where you're converting, uh-oh, got the blue screen of death. That is awesome. Anyways, that will cost you a little bit. So, Rand says, glad you got YouTube up and running on your last TikTok live. You said you did not get around to do tech issues. Yeah, I'm still having the tech issues. I can't get YouTube running at all, even by itself. Like today was supposed to be a test on my PC, and I'm running it on the phone. So that means I can't run a TikTok on the phone at the same time. So I'll have to figure something out. I'd ideally like to run both of them. But I'm glad you're following me on both platforms. Yeah, ideally I'd like to run both of them at the same time, and not individually because it's extra work, but you know. So yeah, anyways, you got me almost all to yourself. So if you got any questions, otherwise I'll consider this a semi-successful test and call it a day. But anyways, my go-tos are CNQ, Dollarama, Go Easy, Hydro One as an investor thoughts. So yeah, CNQ I definitely do own. I think the oil companies are for the foreseeable future, they're making money hand over fist. Like the Canadian companies will be able to break even at roughly $33 a barrel. And I mean, if oil is in the 70s, I mean, it's just ridiculous. I mean, eventually something will happen, but I think it'll take a decade or two. Dollarama, I looked at just today. I was watching a Fidelity seminar, and the manager was very excited about Dollarama. As a value investor, it's too expensive for me. The price to earnings ratio is just too high. On quite a few retailers actually, Costco being a prime example. Go Easy is really my go-to. Um, when they had a little bit of a pullback, I think it was last week, I bought a little bit more. It's behind Manulife. It's my biggest single holding. And so, I think it still has some room to grow for sure. And it's done very well for me. Hydro One, I don't own. I know I looked at it. There was something I didn't like about it. I can't recall what that was. So, okay, this thing isn't rebooting. No. Sorry, I'm just rebooting my computer. I got the Windows 10 equivalent of blue screen of death, and it seemed to want to reboot. I'm sure it was something to do with my messing around with YouTube and the streaming on the PC. Rand says, "Is Manulife still a good buy?" Yeah, in my estimation, it's not as good as it was, a year ago. I mean, it was really in a trading range, and because it was cheap, because it was sort of in a penalty box, they had some trouble in 2008. And so being a value investor, it was constantly cheap and I kept buying it. They kept paying the dividends, so I had no problem. And then something changed, and they were let out of that penalty box, and they were able to break out of that trading range. I it's a little bit expensive. Like, I'm not adding to it at this point because it's my biggest single holding for that reason alone. So I definitely, I'm not adding to it, but I think it's a solid company. Sun Life might be the way you want to go. Where is it? Whoops. Restore, please. Sun Life might be the way you want to go with it. Because they're a bit cheaper, I believe. So for the other folks, if you have any questions about Canadian investing, personal finance, give it a shot. This is my first time trying to stream on Manulife, and on Manulife on YouTube, and unfortunately I'm doing it on my phone. Sun Life has a PE of 13, and Manulife, last time I looked, I think was 18. Let's see, 17 and a half. Yeah. So Manulife isn't as cheap as it used to be, and its yield also came off quite a bit. It used to be 6, and because of that big run up in prices, their yield has come down. Rand says, saw your list online with your holdings. How would you set yourself up as a corporation and why? Yeah, good question. I used to work in IT. Didn't really enjoy it, but it really paid well. So instead of changing careers, I decided to go for the financial independence, right? But from a tax point of view, once you're making over 100K, if you can start contracting and try to do the corporation thing. Generally, if you're working permanent, they won't let you be incorporated. Like, you can have a corporation, but they'll pay you directly if you're permanent. But if you're a contractor, you can choose to have a corporation, and then as long as the money comes into the corporation and it doesn't go on to you, then you only pay like 10% depending on your province. So the idea with a corporation is if you have over 100,000 a year in income and you don't spend every last dollar that you make, money comes into the corp, stays there. The corporation has its own brokerage account, and you invest through the corporation. Passive income is taxed fairly harshly, but it is still better than the corporation paying you either salary, dividends to you personally, and then you investing it. Okay. So some money has to stay in a corporation. That's what the don't spend every last dollar that you make. So I did it for tax purposes, I guess, is the short answer. And you can do it online fairly cheaply. I did it through a lawyer in 2009, and it cost $1,000. So I mean, it'll be probably 2,000 now. Ongoing though, accountants will charge quite a bit to do corporate taxes. So unless you're an accountant, you're going to have to pay at least 1,000. Like, you can get somebody who works out of their basement maybe for 700-800, but I phoned around when I was changing accountants, and it cost in some places it was like 3,000-4,000 to do corporate returns. The accountant I'm with now is about 1,000-1,100, and she does a decent job. So once you establish a corporation, not only that you have to pay to get incorporated in the first place, but then you basically, once it has money in it, you need to keep it going, because if you wanted to shut the corporation down, you would have to you would have to get all the money out and get taxed on it, which would suck. So once you get it started, you have to keep paying your accountant every year to do the taxes for it. So make the decision, and then you have to stick with it. Like, think very carefully about it. But it's for tax purposes. Any contractors will generally do incorporation. Now, if you're a contractor, you can have tax deductions even without being incorporated. You can be a contractor without a corporation. But don't set up a corporation just for investing. Some people seem to do that, and that doesn't make any sense at all, as far as I know. So yeah, you have to work contracts. You can still work 40 hours a week or more, obviously, right? It doesn't have to be part-time, but you're working contracts, and don't spend every last dollar, and make at least 100K. That's basically the rule. So good question. I've done YouTube videos about incorporation and how it all works, and that. So, I mean, I've sort of been through it as a user, but over time I learned more, right? I'm not an accountant, but so I kind of know the basics. Whenever an accountant tries to explain stuff to me, I'm just like, just tell me what to do. Tell me how to invest, and so on. The other thing about the corp is that I made the decision not to pay myself any salary, which means I didn't grow RSP room, and the other thing is I did not, or I could not actually pay into the CPP. So I'm not going to I'm not really going to get any CPP in my 60s. So Rand says, are capital gains or dividends taxed more? Do you know? I'm investing for both growth in TFSA and dividend funds in non-registered account. Thoughts? Yeah, so growth in TFSA isn't a bad idea. If you hit a home run and you get something that goes times 10 for you, then TFSA, it's tax-free. Capital gains are taxed fairly leniently in a non-registered account, though. So if you run out of TFSA room, then capital gains, unless you get $250,000, it's still only that 50% inclusion. So now let me try the scrolling thing. Okay, cool. It works kind of like TikTok. Dividends really depends on the source. Okay. Now I went through hours and hours of effort, so I'll throw it out to you guys on CanadianMoneyTalk.ca, my website. If you go to the resources and education and resources tab, there is a link where I went through all Canadian companies that pay some sort of a distribution, and I looked up, and I put a link where you can confirm it, what kind of dividends or distributions they pay, because they could be paying interest, which will get taxed harshly in a non-registered account. It'll get taxed as salary. They could pay foreign dividends, which will again get taxed severely. They could be doing return of capital, which gets taxed not at all at the time, and then when you sell it, you'll basically pay capital gains on it because it brought down the cost for you. When they're returning your capital to you, your cost comes down. The stuff that I'm aiming for is Canadian eligible dividends, which is especially in lower tax bracket is taxed next to nothing. Like I can get 100K if I have no other income. I can get 100K in Canadian eligible dividends, and I will pay like 5% tax on the whole 100K. And for the first 50,000 in most provinces, there's no tax at all. So capital gains in the higher tax brackets are taxed less, but in the lower tax brackets, Canadian eligible dividends. If you have an American company that pays you foreign dividends, those will get taxed like salary. If you have a mortgage investment corporation, a MIC, that pays you interest, that will get taxed as salary in a non-registered account. Okay? So you have to be very careful and know what kind of distributions it's paying. TFSA obviously is fine. Foreign dividends are going to have that 15% withholding, but if you have growth in your TFSA, then you're fine. Okay, I think I answered that. The Destructive Gamer, I like that name. What effects U.S. election could have on stock in near term? Where best to invest? So in the long run, it doesn't matter which party's in power in the US. The Democrats have a slight edge. You would think Republicans would be better for business, but actually the stock market does better under Democrats, but by a tiny bit, like not, nothing significant. So I wouldn't be selling off anything. I mean, when Trump talks, you don't know what he's actually going to do or follow up on. Like he's not a favorite. Let me put it that way. So today, U.S. banks took off. I own Bank of America and J.P. Morgan. So they took off because he's going to remove the safety legislation, basically. That's one thing. Crypto, because he initially he was against crypto, and then he came out with his own cryptocurrency when he was trying to get more money. So he's presumed to be pro crypto, so that would be that. Anything with renewable energy seems to be sort of in the bad part of Trump's agenda. And on the flip side, anything that's old energy, so oil and even coal, even though he didn't seem to help the coal miners, but coal and oil, I think, is those companies are gonna have a better time of it under him than they would have under Kamala. I'm just gonna check on oil. I didn't seem to do anything today. Yeah, so it's really hard to say, honestly, because you don't actually know what he's going to do. The other thing is that back in 2016, I had a coworker that I was talking to about investing, and he had like a tiny, like a $3,000 portfolio or something. And just prior to the election, like he just sold everything off and was all in gold. And just in case Trump got elected, and Trump did get elected, and actually gold went down and stocks went up. There's also just a general positivity that now we know what the result is. Like markets don't like when there's unknowns, and an election is an unknown. So you have more volatility. And then once it gets decided, then generally you have an upward trend. Tony says, is the overall market expensive in your opinion? Yes, in the US by PE, it is expensive. It is not only that it's the highest PE out of all of the markets, it is also higher than its own average. So the US is expensive. I mean, it's near all-time highs. I know it's nearly impossible to time it, but just your general feeling. Yeah, but so you're right. I was just going to say timing the market is a bit of a fool's errand, and when we just don't do it right. So every time it hits a new high, like if you sold out, yeah, if you had one ETF, maybe, like I said before, I'm not going to liquidate my whole portfolio based on a hunch, and pay taxes and like all these horrible things, right? Like that's not That's not something I want to do. But keep in mind, over time, the market keeps making new highs. So, like if it makes a high, you sell off, and then maybe it pulls back a little bit. Like, do you buy in right then? Do you wait until it pulls back 5%? What if it never does? What if it keeps climbing? Now you're underperforming. So, just basically, anytime, here's my rule or rules. Anytime I have money available, it's going in when I get some cash. I keep trying to have an emergency fund, and I just like, oh, I could buy one of those. I can buy some of that. Today I bought, opportunistically, I bought a little bit more BCE, which, like it's not going to go bankrupt, but it could certainly go lower. So I threw in a little bit more money. So it's timing it is really tough that way. So whenever I have money, I'll put it in, and decision made. Like I'm not going to sit on cash and then watch the market grind upwards. One of the guys in the Vancouver Investing Club that I'm on, he's last time I heard he was like 30 or 40% cash of a significant portfolio. And like the market keeps grinding upwards, and I'm just like, okay, like, what are you going to do? Like, you missed out on all this. Are you going to put the money in now, and it's going to possibly fall, right? Like with bad luck. The other thing is, if the market drops 20%, so if it becomes a bear market, I'll borrow some to invest. Like, I don't want to have cash sitting around, but if there's an opportunity, I'll borrow and I'll pay the interest. So that's sort of how I proceed. Rand says, any idea why Buffett's selling, dumping Apple shares? I heard he made a ton and wants to minimize capital gains if tax increases. I mean, under Trump, they're not going to raise taxes. But I think Apple was just high. So, like, I'll listen to any disclosures that happen to come my way. Like, I don't follow Buffett religiously. I think they're collecting a lot of cash at Berkshire, and I'm not sure why, because they're not getting very much on it. And like they're looking for that unicorn where they're going to get a 20% return a year, and in the meantime, they're sitting on like a half a trillion in cash, and they're getting they're getting like 3% or something, which is underperforming the market. So I think they need to buy something, and I think that's why Buffett is trying to get some cash in addition to what he already has. I don't know what huge company he's going to buy, but I think just Apple was just overpriced, and so he started getting out of it. So that's all. And I don't know about capital gains. I wouldn't expect Trump to increase them. I'm not really seeing that. He's all about lowering taxes. Tony says, I'm 50% in bonds. I think a recession might be coming next year. Okay. I'm not a bond guy personally. By the way, is this the same Tony as Tony 2013 or 2018 on TikTok, or is it a different Tony? Just curious. I'm not a bond guy. Bonds underperform the stock market over the long run, and that's all I kind of need to know. I do have a few balanced funds which contain Canadian bonds, but those are actively managed, and I'll let them do it. Tony, what do you base that a recession is coming? What do you base that on? Because the central banks on both sides of the border, like, kudos, they hit that soft landing. They avoided a recession, and inflation came down. Like, whew, with the blunt instrument that interest rates are, they knocked that out of the park. So with interest rates coming down, recession wouldn't be my base assumption, in all honesty. Because like the economy, if anything, is going to speed up, and even with the high interest rates, we didn't get into a recession. So I don't know. Like I hope we don't have one. Obviously, you do, but yeah, the bonds are going to underperform in the meantime. So it wouldn't be the way I would go. But I mean, to each their own, right? That's what makes a market. Rand says, "What are your own rules when trading on margin?" Um, yeah, good question. So margin. Uh, I mean, I'm 51 years old. Like I don't need the thrills anymore, frankly. But I had four houses in the U.S. and I would borrow on margin, or I would just borrow to invest, and then I would sell a house one per year, and that would pay off the margin, and I would do it again. And basically, I just borrowed when there was an opportunity. So the interest that I was paying on the margin or on the loan was basically just the price in order to perfect the timing of when I was putting the money in, right? So the last house sold in 2013, sorry, 2023. Let me concentrate. Sold in 2023, and I ran out of houses and ways to pay off these things. So then I sort of started doing a um, a wheel strategy with options. So mostly for accumulation, I sell puts. I do it once a month to expire 6 weeks later, the third Friday of the month, and I sell it first Friday the previous month. And eventually I'll get the stock. And when I had the houses, in order to pay off the margin, I would keep the stock. But once I ran out of houses, now I started doing sell a put, sell a put, sell a put until you get the stock, and then sell a covered call until you lose the stock. You pay the margin back. So like right now, I don't have anything on the margin at all. But I, maybe I'll get something on December 20th with some of the movement that we've had, and then I'll just turn around and I'll just start selling covered calls. And it's double-digit returns just by having access to money. So in fact, I bought this opulent house in Edmonton on margin because it had a lower interest rate than my HELOC. And I paid that off as soon as I sold the condo in BC, where I came from. The Destructive Gamer says, "Thank you for providing honest opinions. I try. Remember, they're just opinions. I'm not providing financial advice. This is for education and entertainment purposes only." I appreciate your authenticity. You're most welcome. Your videos are very informative. I do try. What is your goal with this channel? So, really just to help people at a high level. I started it 4 years ago because I stopped working. I had 3.3 million net worth in 2020. When I stopped working, I'm just like, I don't want to work anymore. So I stopped, and because I had all of this information, and I had been running lunch and learns for coworkers at work, basically anybody who would listen. And so somebody says, "Hey, start a YouTube channel." So I did. 4 years later, 1,400 subscribers, not really what I was hoping for, but it is what it is. I think I'm helping people. Yeah, and then I did the TikTok, which the videos are faster to make. I don't write them and then record it and edit a 10-minute video. The TikTok's a little bit easier. I just make some notes and then get it in 1 or 2 takes and no problem. But the goal is just to help Canadians in all honesty. I did record a couple of courses. They're like 5-6 hours. They're on CanadianMoneyTalk.ca on the website, and they're $50 for 5-6 hours of content. The basic one is like what they should have taught us at school, and then the advanced one is stock analysis. I do want to approach a couple of local colleges, universities, and high schools and see if they want me to, do a seminar, maybe run. I don't know exactly what it would look like, but I think people are getting out of university and high school without any knowledge on personal finance, and I think that's a shame because people get into trouble. And so that's sort of my goal, I guess, is to give something back on some level, to give out all that knowledge that sort of helped me get to where I am. I'm at 6.1 million today, so it gives me something to do maybe as well. So I hope that answers. Rand says, can you explain wheel strategy? Did not follow your short TikTok post. So, okay. Options are so much more complicated than stocks. Like in the depths of COVID, I'm like, okay, let's learn about options, see how, and it like poof compared to stocks. Ranj, let me answer your question. Stuart has maybe a quicker one. So if I just have index funds, Stuart says, can I build a good nest egg? Absolutely. Yeah. If you want an example, it doesn't mean that it's right for you, but I'm running 4 index ETFs in my TFSA. Go CanadianMoneyTalk.ca, my portfolio. I publish once a month my whole portfolio. Go to my TFSA, and there's 4 ETFs in there that cover the whole world, and you can play with the percentages as you feel appropriate. So index funds actually are a good way to start. They're simple, they're low fee, and you don't have to do anything. Basically, you don't have to compare your assets performance to an index, because the index fund is the index. So it makes it that there's no guilt or no fear of missing out that something else is doing better. You have what everybody compares their stuff to. So absolutely. So Ranj, sorry if I'm not pronouncing that correctly. So this is very simple options. So stock price is here, and first Friday of the month I go and I'm like, okay, these are the stocks that I have. If I have them, then theoretically I like them and I would want to buy more. So I'm going to sell a promise, a put. It's called a put option, at a strike price, at a price that's lower. I get cash right up front. It's a couple of $100, but it's only applicable for 6 weeks. It expires after 6 weeks. So if you annualize it, it'll be at least double digits. It'll be 20%, 30%. Okay, stock is here. I sell the promise to buy here. So if the stock goes up, and I mean, this is really what I'm thinking, the stock market goes up over time. I picked out good stocks. They're going to go up. 6 weeks is a bit short time frame, so I use a little bit of technical analysis, which I'm not a huge fan of, but for 6 weeks, that's really all you can do. So if the stock goes up, this will expire worthless. Nobody will take me up on it. Nobody's going to sell me their stock at this price if the current stock that they have is here, right? So that's what I'm hoping for. And in that case, I collected the premium right up front for basically no cost. What happens if the stock goes down is that I have to buy it at this price, even though the stock currently is here. My psychology on that is, well, if I just go and buy a stock, and it goes down 10%, I'm not going to panic and sell it. I'm going to hold on to it, maybe add to it. So my thing is, I'm getting a premium to get something that's cheaper than it is currently at the time that I'm selling it. It obviously moves after that. So about a quarter of my of these things that I sell, these put options, I will end up getting the stock, and I always take it, always. Um, Out of like more than 300 times that I did this, I think um, I got out of it like twice. And now I have the stock. Now I'm getting dividends, right? And what I do is then I do the opposite. So the stock price is here, and I will sell a promise to sell my stock at this price. So that's called a call. It's the other way than the put. And it's called a covered call because I have the stock. So if the stock goes down, I'm getting capital losses on paper, but I had collected a premium for selling this. If the stock goes up, I sell it at this price, even though the stock might be up here. So I miss out on this. If I do that maybe on stocks which I think have sort of peaked or are going to be stagnant for a little while, and then I sell the covered call. I get my money back. I lose the stock. I get my money back. I pay off the margin, and then I start selling puts again. So that's why it's like a wheel, right? Rinse and repeat. Stuart, we answered. Gaia says, would it be too late to start investing in the 50s, especially if one does not understand much about it at all? What is the best way to do it and not screw up? So Gaia, there is no bad time to start. It would have been better to start yesterday or ideally in your 20s, but we are where we are. Can't turn back time. Um, Obviously, depending on your savings rate and how much income you're making, you're probably not going to make it to 10 million, right, by the time you retire. But anything is better than nothing. So it's like, well, I can't make it to 5, 10 million. What's the point? Well, if you make it to 300,000, 400,000, it'll still be a very nice little pickup, especially early on in your retirement when you're still active and you want to travel. It'll be nice little bonus. So it's never too late. It would have been better. I'm gonna say a few cliches. It would have been better, years ago. The reason, first cliche, the reason somebody can sit in the shade today is because somebody planted a tree 20 years ago. But especially if one doesn't understand much about it at all. So Gaia, honestly, it's not difficult. You don't have to do anything terribly complicated, sophisticated. You don't need to use a financial advisor. Financial advisors will typically sell you high fee stuff, okay? And thanks to the fees, it won't perform very well. So you can do it yourself. I had mentioned earlier, you can just do it using ETFs, which stands for exchange traded funds. It's just a basket of assets, okay? I'm sort of going to talk about stocks. Generally, you just keep buying, okay? As long as you have income, you keep buying and you keep accumulating that nest egg. The not screw up, if you so what I do, and you can look on CanadianMoneyTalk.ca, my portfolio, and if you look at my TFSA, that's an example. That doesn't mean it's right for you. I don't know what's right for you, but it's an example of what I do. So I have one ETF, right, exchange traded fund. It follows it follows the Toronto Stock Exchange. Okay, so like if on the news you hear, oh, the Toronto Stock Exchange was down today, they're talking about an index. It's a formula. It's 100 plus stocks on the Toronto Stock Exchange that sort of represent it. They add them all up together, they divide it by a big number, and then you get an index number. Okay, so you can get an exchange traded fund that follows this index. So that way you're covering Canada. For me, this would be fun. For you, it might be harrowing, but you say, so where do I think growth is going to be? Is it going to be in Canada? Next stop is it going to be in US? So you can do an index that follows, it's called the Standard & Poor's S&P 500. It's 500 of US biggest stocks. Okay. This is very vanilla. I know it sounds a little bit complicated, but it's not. And if you like, you open up a brokerage account, and you can buy these once a month. You can automate it on some brokerages by filling out a form, and it's simple. So the second one is covering the US with the S&P 500, 500 of the biggest US companies. They're usually multinational as well. So somebody had asked earlier whether just do the US, and you could argue that by getting the S&P 500, you're covering the whole world. But if you actually want to go outside outside of North America with your indexes, the third one is EFE. So that stands for Europe, Australasia, Far East. So EAFE. And every ETF company has stuff that covers this. Okay, there's dozens of them out there. They're usually just competing on being the lowest fee. Okay, so EFE is developed markets, but Europe, Australia, Asia, and then the Far East, which would basically be Japan. And then the last one, which my personal investing thesis is that's where the growth is going to be, is in emerging markets. So this is your Vietnam, Cambodia, Thailand, okay? Africa, pretty much all of it. They have a young population, a growing population. Having traveled there, there's limited use of technology. Like, you have people, huge field, and there's this sharp, long grass, and like I'd be just like, yeah, just run a combine through it. Nope, they're hacking away at it with machetes, basically. I'm just like, oh my God. But you add even a little bit of technology to these places, and their efficiency and productivity is just going to skyrocket. Okay. Plus, they have consumers for their own products, and they have people who are going to be working for a long time because of the young population. So that's my own personal investing thesis. If you do look at my portfolio, you'll see that the emerging markets is a little bit overweighted. So you sort of need to find that right balance for yourself. Maybe you say, I don't think Canada's going to grow at all. I'm just going to ignore the TSX part. Okay. And then you choose a brokerage. Okay. Make sure you understand. So if you're going to be buying $100 into each of these ETFs, $10 coming off of it sucks. So there's brokerages like Wealthsimple and Quest Trade for purchasing of ETFs, but there's no commissions. So you might want to take a look at those. All right. Some of them let you fill out a form, and you give them your checking account information, and they pull the money automatically. You don't even have to transfer it and press the buy button. I like going in once a month and making the purchases myself, and then I say, we'll do emerging markets again, or no, maybe let's do Canada this time. I want to add a little bit to it. So that's how you would go about it. So I'm hoping you're still on, and I'm hoping that helped. If you go to CanadianMoneyTalk.ca, there is information on there. If I can help, it sounds like you're still starting out and you're feeling a little bit maybe that you missed the boat a little bit. We could arrange something as well, just to get you started. So on CanadianMoneyTalk.ca, you can find my my email address. Okay, Rand says, when and how do you plan to sell off your portfolio later in life? Sell in waves. Yeah, so Gaia says, thank you very much. Yeah, you're welcome, Gaia. So Ranj, yeah, the whole, and actually I just did a video on decumulation and spending money. The thing is, with my portfolio, just with dividends, I don't have any covered call ETFs or any split share corps or anything that has excessive dividends. Like I'm just getting kind of 4%, but I'm still getting over 100K, and of course no mortgage. Bought a house for 400 grand in Edmonton 5 months ago, and so I'm getting over 100K, but I'm spending 30, including taxes. Like I don't own a car. I'm gonna try one winter in Edmonton, biking around. We'll see how it goes. But and I mean bicycling, not motorcycling. So I don't spend anywhere near the income that I actually have. And as far as like selling stuff, like that's not gonna happen. I'm single, no dependents, no kids that I know of, anyways. And so my plan is to give like the portfolio just keeps accumulating. It just keeps growing. A financial plan had me at 9 million, which I think I'm going to surpass by the time I'm 90. I'm 51 now. So my plan is whoever was nice to me last is going to get anything that's tax free, like primary residence and TFSA, and everything else is going to go to charity. So hopefully they'll pay minimal taxes, and I'll pay, or they won't pay any taxes because it'll be gifted in kind. And I think there'll be some taxes to my estate, unfortunately, but it won't be significant. So yeah, there's no plan to sell. Like I got stuff that I like. The Canadian big banks are my biggest holdings. Well, I said Manulife and Go Easy, but the other the big five are definitely up there. And like there's absolutely no reason to sell them. Like I don't jump in and out or anything. I just collect the dividends. Sean says, would you ever come back to BC? LOL. No plans right now. The move was unbelievably stressful, and I'm just like I never ever want to do that again. Like next move I want to make is to a rest home when I can't make it up the stairs anymore. It just like I knew it was gonna suck, and it, oh God, did it ever. Everything from U-Haul not having the truck on the day of the move, and when you're moving inner city, they don't guarantee anything prior to 24 hours. And then when I got to the spot, they said, yeah, the truck broke down, we don't have it, so I had to go somewhere else. And yeah, that started it, and it just kept getting worse. So moving in general, like I know I could pay somebody 20 grand and they would do it, but um, BC is expensive. Like no offense, I'm sure you live in BC, so I don't want to offend. But like not only the expense, it's not that I can't afford it. I sold off a condo because I was having trouble with the Strata Council, and there was somebody smoking in a suite down the hall, and I could smell it in my suite, and the Strata Council didn't do anything. And then when that person unfortunately passed away, but obviously stopped smoking, then literally 2 weeks later, the Strata Council cleaned out the bike room and threw away a bunch of my spare parts and lubricants and a couple of bikes. And I had to go to court. So I definitely didn't want to be in a condo anymore. I didn't really feel like having a mortgage either. And then the thing is in BC, like there's so many natural disasters. I mean, the earthquake could happen tomorrow or never. But I mean, you have the fires every year, and you have landslides. There was, when was it, 2018, 2020? 2018 maybe, when there was the Abbotsford flood, and you had Vancouver being cut off by rail and road for like 2 weeks because there was a landslide. Like I don't want to be forced to evacuate if I go somewhere in the interior and then pray that the fire didn't get to my house. So Edmonton, obviously, I haven't lived through one winter. I had when I worked here many years ago, flying back and forth. So I was here for the winter. I'm assuming it'll be nicer living here. But yeah, we should have the talk about moving to BC after I survive a winter. But yeah, no plans. We'll see. We'll give it a couple of years. One thing I'm not that excited about in Edmonton is that a lot of the energy comes from now natural gas. It used to be coal. They converted very recently to natural gas, but still nowhere near as clean as a hydro, obviously in BC. So you know it is what it is. Uh, but I've enjoyed it here. I go running. I got a lots of room. I've got a home gym in the basement, and I go biking. But when it's minus 40, my neighbor told me minus 60. Like that's not great. So we'll see how all that goes. But yeah, so far so good. Otherwise, I picked a place where I'm walking distance to everything. But anyways, you guys probably don't want to know about that. Any questions about personal finance, investing? Um, I can look at a stock or throw out an opinion. And again, this is all sort of for education and entertainment purposes, right? I'm not giving you financial advice. I'm neither licensed um, nor more importantly insured for financial advice. Rand says cost of living much cheaper in Alberta. Yeah, but I mean, like, I sold a condo in BC for 550, and I mean in Surrey, BC, not even in Burnaby or let alone Vancouver. And I bought the house much bigger, much nicer, nobody stomping on my head, and obviously no strata, and for 430. So I pocketed 100K. Paid off one more margin loan too. Um, so like in the condo, I was paying 500 in strata fees per month. The insurance for the condo was as high as house insurances in Alberta. Groceries are roughly the same. Property taxes are going to be maybe a little bit higher on the house, and I saw something that they were going to go up quite a bit more. Uh, but like for me, it doesn't matter. I just wanted peace, and like the people above me were idiots. They would drop something at 1 o'clock in the morning on the floor, and they just no clue, or maybe slam a, a door. Like I don't know, it would go bang, 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 bang. And so like they dropped something, maybe their false teeth or something. And like they'd wake me up. It was like they were idiots. And I would go talk to them and it's like, eh. Anyways, Stuart says, so yeah, it is cheaper. Obviously, the real estate to purchase in the first place is definitely cheaper, right? Like I said, condo more expensive in BC than a detached younger house in Alberta. So in Edmonton, Calgary would be a different story. Edmonton was cheaper. I didn't really care where I went. I did a comparison sheet where I had requirements and then I had weightings, and then for different cities I kind of did Alberta, Manitoba, Saskatchewan. For different cities, I did a whole bunch of research and I gave it a grade, and then I just multiply the it was like 1 to 9, 1 meaning not very important and 9 being very important. So I multiplied the score that it got, again 1 to 9, and then totaled, and Edmonton won. So Edmonton it is. So VFV Stewart says, Sean says, I was going to invest in VFV too, but I waited. Now it went up. Yeah, like timing it like that, that's not really what I would try to do. That's not the intention of it, right? It's a buy and hold thing and keep adding to it. Like becoming financially independent, retiring with dignity, whatever your goals are, it is it is it is simple. It's not always easy, but basically you need to have self-control, spend less than you make, and invest the difference. That difference depends on your goal. Okay, 15% of your gross income is what they say you should be investing if you want to retire in your 60s comfortably. If you want to retire early, then it needs to be 25, 30, 35, 50. At the end of my career, I was investing 85% of my income because I was still living on 30,000 and I was making 200,000 with the contract in IT and then another 50 in rents and dividends. So because I really wanted out. So that all depends, right? But it is really simple. Just keep buying on a monthly basis. Sometimes you'll get in just before a jump up. Sometimes you'll miss the jump, like it sounds like you did this time around. But like automate it if you can, and then if you have extra money, throw extra money in. So anyway, VFV is the Vanguard S&P 500. It trades on the TSX. So you give it Canadian dollars and they will convert it for you, so you don't pay the 2% penalty that most brokerages charge. Because it is foreign content in TFSA, RSP, and non-registered, you are going to have 15% withholding of the foreign dividends that it pays. Okay. In a TFSA, they'll clip you the 15% of the dividends. You'll never get it back. In a non-registered account, they'll take the 15%, but you'll get a tax credit at tax time. Now, with an RSP, it's a little tricky. The VFV, if you have it in an RSP, they too will take the 15% of the dividends because they're foreign dividends, and you will not get it back. What you do is if you have foreign dividend payers, you have to make sure that they are foreign traded. So if you have American dollars or you don't mind paying the 2% conversion fee, right? That's something you need to calculate. Then VOO, which is S&P 500, but it is US traded. Okay. So that one will not have the 15% withholding, or if you buy Boeing or if you buy JP Morgan traded on the US stock exchange, that will not have the 15% withholding. So I as far as it going up and so on, today it went up because finally the excitement and the uncertainty of the election is over. Okay, and everybody feels better about it, and they think that Trump is going to be better for business, which is arguable. Okay. Stuart says, "Do you ever think you'll get a car?" Yeah, I'm gonna try one winter and see how it goes. If it's just like a total pain, like I can walk to the grocery store, Canadian Tire, Rona, like all of that is walking distance for me here. And I'll see how the one winter goes. I'm also going to try to date, and I'm not quite sure how that's gonna. In Surrey without a car, it sort of worked, not great. It may not fly at all in Edmonton, so we'll see. I like that anything on a bike, like I got a used bike for $20 at a garage sale, and I can either work on it a little bit and then use it, or just use it for spare parts. A car, like you just go see a mechanic and it's in hundreds of dollars. Not that I can't afford it, I just don't want to pay it. Like I would like to be self-sufficient. And it's just me that I'm making the decision for, right? Like if I had a wife and kids, it'd be a slightly different story. I mean, I've had a pretty good record of not having a car. I've never owned one. I've had access to one when I was living with my ex years and years ago, and obviously when I was living with my parents. Um, Cars are depreciating assets, but then stuff doesn't take a long time. But I also like biking because it's good exercise. And like I'm afraid if I get a car that it's like, oh, we'll drive there and we'll drive there, and then my health will go downhill. Anyways, Kiel says, how do you think about buying US blue chip ETF now? Which one do you recommend? Thanks. You know what? Just the S&P 500, I think would be good enough for me. I think I'm fairly risk friendly, so S&P 500, or I don't own the triple Q. I don't own the Nasdaq 100, but the technology portion of the Nasdaq 100 is quite volatile, and I'm fine with it because I always think I have at least a 10-year, if not more, time frame. So I'm actually sort of going to the other side where I'm more risk friendly. But if you want to buy like the Dow Jones, I think it makes sense, right? It all depends on your risk friendliness. If you don't like stuff that moves too much, then blue chips are good for you. Obviously, there's a correlation between volatility and return. So you are going to by having big companies, they're not going to move as much up or down. So you get safety, but you get penalized a little bit on the return. If you buy the Russell 2000, which is small caps, you're going to have a lot of movement, but if you stick to it for a decade, you're likely to do quite well. But it's going to take your money for a ride. So it all depends on what your risk friendliness is. If you're learning to blue chips, if you're leaning that way, it's all good to me. Sean says, thanks, Celeste. The thing I'm paying $10 for commissions per purchase. Hard to pay that many fees to dollar cost averaging. Yeah. Do you think it's best 100% to switch over to non-commission brokerage like Wealthsimple? Yeah. So like I'm with three different brokerages. My first one was Qtrade. that took my corporate and that took my mutual funds. Then I started Wealthsimple. I only did it for Canadian stocks because I didn't want to pay the 1.5% conversion for US stocks. And then for a cheap margin account and for options, I do Interactive Brokers. They're great as far as fees for options. And it's a hassle to have three. You don't really get a complete picture anywhere. So the reason I bring this up is you could do some, just start accumulating with Wealthsimple. Because Wealthsimple, you get what you pay for, in all honesty. They have no research at all. But Qtrade, they have Desjardins and Morningstar research, which is great. I look at that all the time. You get monthly reports and things like that you can download. For a little while, I was sending them to my friends until I discovered they weren't all that interested. So there's definitely bonuses for that. I'm sure, like if you're with TD or somebody who charges the $10 or $9.95, you get what you pay for. Then again, the big banks make a lot of money, so maybe you're paying that. But if you're doing $10, then you need to do lump sums. And so Qtrade had a promotion that if you open a new account, in addition to the ones I already had, and you put in $5,000, they're going to give you $250. I'm like, so I opened a new account, I transferred in 5,500, and then I'm going to pay $695. Qtrade, if you have enough money with them, they charge you $695, not $10. And I'm just like, no, let's do at least $6,000. So to make it a smaller percentage of the total. So if you have something that's charging you $10, then you're doing lump sums basically of at least what, $5,000, $3,000. I mean, you don't really want it to be that big, right? So then you're having to accumulate the money, and therefore the money's not working. It would be completely undoable if you were doing a couple of $100 each month into 3 ETFs each, like that. That would just eat away at any possible gains. So yeah, that's not a thing. So you either have to do lump sums where you accumulate and then it's not working. Maybe you can time it or try to time it, right, rather than having it automated. But like Questrade lets you buy ETFs without a commission, and Wealthsimple, doesn't have the bells and whistles. But yeah, I would kind of think of it that way. Having more than one brokerage, you don't get a complete picture anymore. So I like all the exports that you see on my website are coming out of Quicken, where I hand enter all the prices once a week, and that's how I get a complete picture. I mean, I have the same stocks in different accounts as well, not just brokerages, but like my corporation has Go Easy, and my Interactive Brokers has Go Easy, and like they're different brokerages and different accounts. So it, ends up being a bit of a mess. But yeah, I would, the fees will kill you. If you're doing small amounts, the fees will kill you. I mean, the fees aren't pleasant in any case. The brokerage needs to stay alive somehow. Like I get that, right? But then by law, they have to disclose how much you're paying in fees. So you get that once a year. And it's like, oh, I paid Qtrade $160 last year. I didn't think I did, but it all added up, right? So, and yeah, if you do it over a year or a decade, like it adds up. Like you could have gone for a nice dinner or something instead, right? Used it. Like Wealthsimple has sort of a down If you guys have any other questions, otherwise I'm just gonna keep doing stream of consciousness. Um, Wealthsimple, like they don't work for free either. They the way I understand it, they do something called front running, where you place an order and they send it to whoever pays them, and then that company says, "Oh yeah, that stock. Well, there's enough orders here that it looks like it'll drive the price up. So let us come in now, delay the orders until we tell you. Let us come in, and this is all in milliseconds. Like you won't notice anything. Uh, so they get in at this price, then your orders get executed. Maybe you won't get the price here. Maybe their purchase or other purchases drove the price up in the meantime. So maybe you're buying a little bit higher, so it's costing you that way. But people feel better about it because they don't see it. So so that's called front running. I understand that's what Wealthsimple does. That's how it makes money. Like the company, like nobody works for free, right? Companies don't work for free. Wealthsimple actually, and I have no relationship with them other than having an account with them. Um, I have no relationship, but I like them. Like they're starting a margin account. They had private equity, sort of a mutual fund, like fairly vanilla. Like you didn't have to choose. Like with my private equity, I'm choosing to buy self-storage, car washes, and stuff like that. So Wealthsimple has like a packaged one where they make the choices and you just buy the package, which is probably fine for most people. So they do that. Because I have over $500,000 with them. There's all sorts of stuff, including access to a financial advisor, which is nice. Somebody to chat with about my portfolio, because otherwise it's just me in my own head, and you know, everything looks great if you thought of it. So there's that. They gave me access to Willful. I hadn't tried it yet, but so I'm gonna make a will, which has been on my list for a long time. And yeah, so they have some perks, but the other brokerages also see money moving, and they're trying to give bonuses, like I said, Qtrade, give bonuses for new accounts and so on. Actually, I just finished or an attempted negotiation with Wealthsimple, because Wealthsimple right now has they'll give you an iPhone if you transfer in at least 100K, and then you get a better iPhone the more money you transfer in from another brokerage. And I have like 530,000 US in US stocks with Qtrade, which they're charging me the 695 or whatever it is for each trade. So I'm like, well, we'll go to Wealthsimple, but I don't want an iPhone. So they had a promotion previously where they gave you 1% of what you transferred in. So for me, that would have been five grand and change. So way better than an iPhone, anyways. But then they said, well, the promotion isn't on anymore, and they basically declined it. So I'm like, well, we'll keep the money in Qtrade, and when you guys are ready, let me know. So Stuart says, how do you value the pension? When you say the pension, like you mean just pension in general? Well, I mean, you can do like, and are you asking like getting a lump sum payout versus getting paid out monthly, smaller amounts, like actual pension? So just to make sure I'm answering your question. Oh, government plan? But yeah, are you like being given a choice to pay out to get a lump sum payout? versus like waiting maybe a few more years and just getting a monthly payment. Yeah, I mean that seems to be the usual decision. Yeah, you can see what the lump sum is, and yeah, okay, yeah. So you're one of the few remaining that still has a defined benefit pension. So you're basically asking, should I take a lump sum now or wait a few years till 60, 55, whatever, and then get monthly payments till my last day, right? So yeah, I mean the lump sum you can sort of expect to get 7, 8%, let's say. And so just do the math off of the lump sum, assuming that you're going to get 7%. That should be doable, and see what those payments are. So you can put it. You can if those payments are beating the monthly pension payments that you're going to get, the lump sum is better. If the payments are higher than what the lump sum will generate, then the payments are better. You can also put the payments into a financial calculator. There's plenty free ones online where you can kind of see what it's worth, right? The variable there is how long you think you'll live, and there's longevity calculators out there as well. Uh, like for me, it's like, oh, you don't drive a car, you exercise, you don't smoke, 90. You're 6'4", 80. I'm like, oh. So I'm hoping to make it to 90, but like depends on your family history as well. So you can sort of use the financial calculator to say, okay, at 60 for 20 years, what is the value of those payments today versus the lump sum, and then the lump sum can get me 7%. And generally, they're going to be. It just really depends on what the rates that you're using are. I mean, they make it to be fairly neutral. That it's a sort of a break even whether you take the lump sum versus the payments. If you live till 82, it seems to be the average Canadian age these days. So if you live that long, then it's generally neutral. Gaia says there's a platform called Moomoo, supposedly commission free. Yeah, they wanted me to advertise on TikTok. Moo fees Canada. Zero commission online broker. Yeah. They might be more for day trading, that they concentrate more on like technical analysis rather than actual research, which costs a little bit more. Technical analysis, you just get a bunch of graphs and stuff crosses over and so on. Yeah, Moomoo's more for day trading, so they won't give you the research either. But yeah, and I think they're probably just on the phone. So which, well, simple. Their phone app has more functionality than their browser version. So yeah, you can check them out. If it does look like they're commission free, as long as you know what you're buying, you don't need the research, and you can buy it on that app. They are legitimate as far as I know. It wasn't a scam or anything. So Stuart says, how do you factor it so the payments into your retirement plan, plus the plan is indexed? Yeah, so CPP and Old Age Security are indexed as well, which is very helpful, right? If you're afraid of running out of money because of inflation, then CPP and old age security are indexed. But yeah, that's the gold-plated. Some unions and most government have teachers and so on have pretty nice defined benefit plans. So some people is like, yeah, no, I don't want the lump sum. I want the safety and security, and then it sort of works like an annuity, meaning you just get a stream of cash. There's really no risk. So in that case, you can look at it as safe, same with CPP and old age security, and then the rest of your I don't know if this is what you're asking, but the rest of your portfolio can be more risky because if stuff goes up and down, you don't have to sell it if it's gone down because you still have this income. So it's nice. With the lump sum, you get the money earlier, you get all of it, a little bit less probably, but you can invest it on your own. I don't know about the government plan, but CPP, if it's employer, if the employer contributes half and you contribute half, the returns are about 8%, depending on how long you live when you take it and so on. If you're self-employed and you're paying both sides, then the return logically is 4%, so a little bit less. So that was one of the reasons why those of you who were on earlier, when I said made the decision to be incorporated and pay myself dividends only, so I didn't have to pay CPP. That's because I was self-employed and I was only getting 4% return on the average, right? Obviously, if you can, if you don't need the money and you think you're going to have a long life, take CPP and old age security as late as possible, because then you get more. I'm assuming the government plan Stuart's talking about is something similar. Let me quickly mention, and then I'll get back to the retirement plan. Let me quickly mention something. The bucket portfolio. Okay, it's basically something that prevents you from having to sell in this is for retirement, from having to sell in retirement something that's come down, and it also allows you to beat inflation. So 3 buckets. Okay, first bucket, 2 years worth of living expenses in cash. It's not going to beat inflation, but 2 years is typically when you have a bear market. It always recovers within 2 years. What happened in 2020 was quick crash and then quick recovery. That's not normal. But normally 2 years is like the longest one. So you have 2 years of cash to live from if there is a crash. And so that way you don't have to sell when the market's tanked. Second bucket is going to be your large caps, fairly safe stuff, bonds, as somebody was asking about earlier. That is years 3 to 10, so 8 years worth of living expenses. That's sort of, we've emptied out the first bucket, plus the bonds and the large caps are probably going to have some dividends, so there's going to be some cash flow and interest. Okay, some dividends and interest. And then the rest of your portfolio, hopefully the biggest part, is bucket 3, which is all stocks, volatile, but that's going to outperform in the long run, and that's what's going to beat. That's what's going to beat the inflation. Okay, so to go back to Stuart's point about the retirement plan, if you have guaranteed, safe, and indexed to the CPI, to inflation, if you have money coming in, that can be your bucket 1. That can even be your bucket 2. So the rest of your portfolio can be super volatile, and have good performance because you don't need to look at it. If it goes up and down, if you need it to be up to buy groceries, then that's pretty stressful. But it's like, yeah, I got my groceries covered. This is my holiday budget. If it goes down, we won't go for holidays or something. I mean, you can fine tune it, but Google bucket portfolio if you're interested. It's quite interesting. Anyways, been at it for an hour and a half. Actually, TikTok, my record is like 7 hours. I stayed on because people kept asking questions, but uh, this is the first time I'm doing a live on YouTube. Um, I'm gonna TikTok I do every 2 weeks. So this was my off week. So if I can get TikTok and YouTube working at the same time, I'll do it next Wednesday, 6 p.m. Pacific, 9 Eastern, 7 Mountain Time. If I cannot get it working, TikTok and YouTube, then I'll do YouTube in 2 weeks and alternate TikTok and YouTube. So yeah, and Gaia, if you're still on, if you're starting to feel a little panicked, shoot me an email. We can do a video chat. I'll try to help you at least to get you a little bit more comfortable, because it sounds like you got 10 years, 15 years left, and it's like it's time to go. Okay, guys, any last questions? Otherwise, I'm gonna call it a night. Thank you for joining me. I hope it was interesting. And again, my website, CanadianMoneyTalk.ca, all sorts of interesting stuff, including my net worth, my portfolio, and yeah, Gaia, you're welcome. Seriously, shoot me an email. We'll arrange something. Um, I'm kind of feeling you're not comfortable, and if I can help, I'm happy to. All right, guys. How do I stop this? Okay. Well, everybody have a good night, and I'll try to see you in a week. At worst, it'll be 2 weeks. Bye.